The coming stock market crash is going to be worse than 1929. That's what experts are saying. A lot of experts. If you know Michael J. Burry, he was the one who shorted the housing mortgage markets back in 2008. Famous investor. He is a by the numbers kind of guy, and he's been going over the numbers for the last decade, pointing out all the ways that our system is totally off base. And he just put out this tweet. Of course, he tweets and then he deletes his tweets because of reasons. I don't know why. But he says this: difference between now and 2000 is the passive investing bubble. That inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and still the door is only so big. What he's talking about is he's talking about the ETFs out there, the exchange-traded funds, the mutual funds, basically, because these companies are buying up individual stocks and creating these baskets. You're buying, and you think you're buying stocks, but you're not. You're buying baskets of stocks, sort of, but you're really buying promises of baskets of stocks. The problem is when you start selling these baskets, it's going to force sales to the point that a lot of these stocks are going to be, they don't trade that many stocks per day. When these ETFs start dumping all these shares, there's not going to be any buyers. And when there aren't any buyers, if you have a basket of 100 different stocks and only one of those stocks can't be sold, it's going to get marked down to zero. If there's no buyers in the market, if there's just not enough buyers out there at any price for certain things, it's going to start marking those things down. There's a lot of discussion about kind of how ETFs will really handle a market crash. Because remember, there weren't ETFs in 2008. This time around is the first crash where we're going to have these new and improved securities. We know what stock market crashes look like because we've had stocks since forever. But we haven't had these baskets of stocks. And more importantly, when you start looking at the percentages of the money in the markets are actually invested in these baskets, it's going to be catastrophic. Particularly with bonds. Every time there's a stock market crash, bonds lock up. That's what happens every time. And people lose their shirts because when they start to try to sell these bonds, there just aren't buyers. These bonds have very low turnover per day. And when people start trying to dump them on the market large scale and there's just no buyers, the prices can drop 20, 30, 40, 50% in one day. This has happened in 2008. This happened back, not quite so much in 2001, but when you go back to other stock market crashes going all the way back to 1929, the bond market is always a surprise to everybody. Everyone's there like, it's less risky to be in bonds until there's a stock market crash. Then it can actually be much worse than stocks. What he is suggesting, and what others have suggested too, is that these ETFs, these exchange-traded funds like SPY, QQQ, very popular ways of investing in the stock market, they aren't actually stocks. They aren't exactly stocks. And when there's a market crash, how are these because who's actually creating these baskets of stocks? It's the banks. And they are, the way that they create these shares is a complicated fashion. What happens when these banks step out and say, we're not going to do it? We're not going to take them off the market. We're not going to buy those shares from you. The problems that are inherent in the system, and there's a lot of technical stuff behind there. I understand some of it, but there's huge problems, and the main point is that very smart people are very concerned at how a market crash will go down with these ETFs. And on top of that, we're just seeing across the board some major problems, structural problems, like in Europe. They had negative interest rates, right? But then they forced their pension funds of, all these companies, and including entire countries' pension plans. They forced these pension plans to hold over 70% government bonds. And the problem is that they've been jacking up the interest rates on these government bonds, which de facto makes the value of those bonds plummet. We are looking at the insolvency of the majority of the pension plans in Europe across the board. And those are massive, massive investors. They have tons of billions of billions of dollars worth of investments. And most of those are in government bonds, and they are they're losing everything. They're losing everything. And when these funds are losing tremendous amounts of dollars, they have to make it up somehow. And they're going to be selling stocks. That's what they're going to do. That 30% that they're invested in stocks instead of government bonds, they're going to start dumping those things, and they're going to dump them like crazy. And that's what we're facing right now. How many millions of workers in Europe are going to, have their pension funds go bust in the next number of weeks? We're going to find out. The sovereign debt default that we're looking at here, these countries, the European Union and third world countries who are having the interest rates on their loans go up dramatically, they're not going to be able to make these interest payments. They're going to start defaulting. And even just the threat of multiple countries defaulting on their debt simultaneously is going to scare the market like nobody's business. What do? If you're going to loan money to a country and you're afraid that country is going to default on it, what do? You charge them a higher interest rate, which spirals to causing that country more quickly to default on those debts. It's just one big spiral, and we're seeing that swirling action happening. And the same thing is happening to the pension funds. And as these things start to drop, we're going to see the ETFs basically come over to the fire that's burning and dump gasoline on it and just light everything up. What this will look like when it actually explodes, when it melts down, when we have our Lehman moment, as I was talking about this morning, which we look like we might have in Credit Suisse and Deutsche Bank. It looks like these could be 2 to 3 times bigger than the Lehman Brothers collapse, and it looks like we're on the verge of that collapse. It could happen literally any day right now. You go back and watch that video again, because this is just this is end of the market, end of the Western world as we know it, financial markets. If you have heavily invested in stocks, you really need to reassess your positions, and you need to look at your bonds and realize that those bonds may not be as safe as you think they are. Now, this is not investment advice. I'm a fellow investor. I am an accountant, but I am not an investment advisor. You need to get with your investment advisor or figure things out on your own on what you need to do, what steps you need to take. But this is a moment to have your money and your investments in something safe. If you're thinking, I'll just ride it out, and you're not aware of what's going on in the markets right now, this crash could be bigger than 1929. That's what we're hearing from the experts. Michael Burry, he backed up everything he said. We saw in this end of first quarter, he had sold every single stock except for, I believe, one stock, which is a private prison stock. Apparently, he thinks that there's going to be a lot of money to be made for imprisoning people because the crime's going to go up as the market goes down. But basically, he sold off all the rest of his stocks for his entire investment firm, his private family investment firm. And that's a big deal, folks. We're having people backing this up with their actions, not just their words. Make smart choices out there. Seek investment advice from qualified people if you need it, and try to figure out what's going on and take attention to your investments. But this is going to impact things As the markets go down, people are going to start doing bank runs. People are going to do runs on the stores. A lot of things start to unwind when people start losing their jobs, when businesses start collapsing. Pay attention to what's going on out there, folks, but stay sane, stay ahead of it, and keep on doing smart things. All right, folks, if you found this video useful or helpful, you might want to check out this other video from me right here. Otherwise, I will see you later. Steve Poplar, out.